Everyone keeps asking the same question. When will the stock market finally crash? Experts have been predicting it for years. Financial gurus point to mounting debt, soaring valuations, and warning signs that mirror every major collapse in history. Yet here we are, watching markets climb higher, while ordinary investors wonder if they're missing something or walking into a trap. The truth is, there's a reason the crash hasn't happened yet. And that reason isn't what you think. The system isn't broken, it's working exactly as designed, but it's not designed for you. While millions of Americans check their portfolios, hoping their retirement savings will survive the next downturn, a smaller group of players has rigged the game so thoroughly that what looks like a free market is actually a controlled demolition, waiting for the perfect moment. They decide when the music stops, they decide who gets chairs, and they've been buying themselves time while you've been buying their promises. What I'm about to show you isn't conspiracy theory, it's documented policy. It's public records. It's the mechanics of a financial system that has evolved far beyond anything most people understand. And once you see how the machine really works, you'll realize why predicting the next crash is like trying to guess when a puppet master will cut the strings. The timing isn't economic, it's strategic. Let's start with something that sounds boring but changes everything: quantitative easing. Most people think it's some complex monetary tool that helps the economy during tough times. In reality, it's the most elegant wealth transfer system ever created. When the Federal Reserve announces it will buy Treasury bonds, it doesn't just pump money into the system. It telegraphs exactly when and how much it will buy. This gives banks advance notice to purchase these same securities at lower prices before the Fed drives up demand. Here's how it works. The Fed says it will buy $50 billion worth of 10-year Treasury bonds next month. Banks immediately start buying those bonds at current market prices. Then, when the Fed enters the market as promised, demand spikes, prices rise, and the banks sell their holdings back to the Fed at the inflated cost. The profit is guaranteed because the buyer, the seller, and the timeline are all known in advance. If private companies coordinated this way on Wall Street, it would be called insider trading, and people would go to prison. When the government does it with banks, it's called bold action to strengthen the economy. But the real genius is in the marketing. Quantitative easing gets sold to the public as stimulus for everyone. Help for struggling families, support for small businesses, jobs for unemployed workers. The reality is brutally different. Most of that newly created money never reaches Main Street. It flows directly into financial markets, inflating asset prices that only the wealthy can afford to own. The top 5% of Americans own 60% of all individually held financial assets. When the Fed pumps trillions into those markets, it's essentially printing money for people who already have money. Meanwhile, ordinary families see their purchasing power eroded by the inflation that comes from all this money creation. The cost of housing, healthcare, education, and basic necessities climbs faster than wages. Savers get punished with near zero interest rates while borrowers with good credit get cheap loans. But here's the kicker. The people who qualify for those cheap loans are the same people who already own appreciating assets. They borrow against their stocks and real estate to compound, buy more stocks and real estate, hounding their advantage while everyone else falls further behind. This isn't accidental, it's architectural. The system has been redesigned over decades to concentrate wealth upward while maintaining the illusion of broad prosperity. Stock market indices hit record highs while median household wealth stagnates. Corporate profits soar while small businesses struggle with regulations that favor large competitors. The disconnect isn't a bug, it's a feature. And when people start to notice the inequality, when they start asking uncomfortable questions about why the markets keep climbing while their own situations deteriorate, the system has an answer. Market volatility. Controlled crashes that wipe out leveraged speculators and overextended retail investors while leaving the core players untouched. These aren't natural market cycles. They're pressure release valves that reset expectations and eliminate potential threats to the established order. Consider what happened in March 2020. The pandemic, the perfect cover for the largest wealth transfer in modern create history. Small businesses were forced to close while large corporations were deemed essential. Stimulus checks went to families while trillions went to banks and mega corporations. The stock market crashed briefly, long enough to shake out weak hands, then rocketed to new highs fueled by unprecedented money printing. The wealthy bought assets at fire sale prices while ordinary people used their stimulus money to pay rent and buy groceries. By the time the dust settled, billionaires had added over $1 trillion to their net worth, while millions of small businesses disappeared forever. The market crash wasn't a failure of the system. It was the system working perfectly. Wealth flowed upward, competition was eliminated, and control was consolidated. all while being packaged as emergency response to an unprecedented crisis. The same pattern repeats in every major downturn. The 2008 financial crisis was blamed on subprime mortgages and regulatory failures. But the real story was banks packaging toxic assets, selling them to pension funds and institutional investors, then betting against their own products while lobbying for bailouts when the scheme collapsed. The banks that created the crisis were rescued with taxpayer money, while homeowners lost their houses and retirees lost their savings. Too big to fail became too big to prosecute. The dot-com crash of 2000 wiped out day traders and retail investors who believed the hype about revolutionary technology companies with no profits. Meanwhile, insiders and venture capitalists had already cashed out at peak valuations, leaving others to hold worthless shares in companies that existed only on paper. The crash cleared the field for tech giants that emerged from the wreckage with monopoly power and government connections. Each crisis follows the same script. Excessive risk-taking by insiders, marketing of that risk to outsiders, controlled demolition when the scheme reaches its limits, bailouts for the connected players, and consolidation of power in fewer hands. The timing isn't random, it's planned. And the current market hasn't crashed yet because the consolidation phase isn't complete. But there's another layer most people never see. High-frequency trading and dark pools have fundamentally changed how markets operate. Sophisticated algorithms can execute thousands of trades per second, holding positions for milliseconds while extracting profits from tiny price movements. These systems don't invest in companies or create value. They skim money from every transaction by front-running orders and exploiting information advantages that human traders can't match. Dark pools allow large institutions to trade massive volumes without revealing their intentions to the public market. Over 50 of these private exchanges operate in the United States, processing nearly half of all equity trades. The name isn't metaphorical. These are literally dark markets where price discovery happens away from public scrutiny. Institutional investors can manipulate prices, coordinate strategies, and execute trades that would be impossible in transparent markets. The combination of high-frequency trading and dark pool manipulation creates a two-tiered system where retail investors think they're participating in a fair market, while the real action happens in private networks they can't access. Your buy and sell orders get processed through algorithms that analyze your patterns, predict your behavior, and position before profit from your decisions. This infrastructure, you even make themselves to them, doesn't exist to make markets more efficient or democratic. It exists to extract wealth from smaller participants and concentrate it among the operators of the system. Every pension fund, mutual fund, and individual investment account becomes a source of revenue for firms with better technology, and privilege always wins because the house controlled access. The house the dealing, the shuffling, and the rules. But the most of this happens to understand is that none important thing in isolation. The Federal Reserve, the Treasury Department, major banks, and regulatory agencies work together in what they call coordination, but what functions more like orchestration. When Silicon Valley Bank collapsed in March 2023, the response was swift and decisive. Not to protect depositors, but to protect the system. Within hours, regulators announced that all deposits would be guaranteed, even those above the legal insurance limits. The message was clear. If you're connected to the right networks, the rules don't apply to you. This wasn't about preventing panic or maintaining stability. Smaller community banks fail regularly without extraordinary intervention. Their depositors get the standard insurance payout and everyone moves on. But when a bank that services venture capital firms and tech startups faces collapse, suddenly systemic risk appears everywhere. The real risk wasn't to the economy, it was to the wealth preservation networks that depend on preferential treatment. The banking crisis revealed something else crucial about market timing. These institutions hold massive portfolios of long-term government bonds purchased when interest rates were near zero. When the Federal Reserve raised rates aggressively to combat inflation, the value of those bonds plummeted. Banks were sitting on hundreds of billions in unrealized losses, technically insolvent by any honest accounting standard. Yet markets barely flinched because everyone understood the game. The losses would be ignored, papered over, or transferred to taxpayers through some creative mechanism. This is why the crash hasn't happened yet. The normal rules of mathematics and economics have been suspended for players important enough to matter. When assets lose value, they get reclassified. When institutions face insolvency, they get special treatment. When markets threaten to collapse, they get intervention. The system has evolved beyond traditional capitalism into something more resembling managed outcomes for preferred participants. The timing becomes clearer when you understand the political calendar. Major market disruptions tend to happen when they serve broader objectives or when they can't be delayed any longer. The 2008 crisis emerged during an election year when changing leadership provided cover for unpopular bailout policies. The 2020 crash coincided with unprecedented government expansion and emergency powers that would have been impossible to implement under normal circumstances. The next crisis will arrive when it can be leveraged for maximum advantage by those who see it coming. But markets can't be manipulated indefinitely without consequences. The dystions build up like pressure in a sealed system. Asset prices detach from underlying economic reality. Debt levels reach mathematically impossible territory. Currency debasement accelerates beyond what can be hidden from public perception. These imbalances create fragility that even the most sophisticated intervention can't eliminate permanently. The warning signs are becoming impossible to ignore. Corporate debt has reached record levels, while corporate profits increasingly depend on financial engineering rather than productive activity. Stock buybacks funded by cheap debt have inflated share prices while actual business investment stagnates. Real estate markets trade at multiples that make no sense relative to rental income or local wages. Bond markets price in scenarios that require perfect policy execution for decades into the future. Yet none of these fundamentals matter as long as the intervention machinery keeps functioning. The Federal Reserve can create money to buy any asset. The Treasury can guarantee any liability. Regulatory agencies can change accounting rules to make problems disappear on paper. Congress can authorize spending programs that transfer risk from private actors to public balance sheets. The system has become self-referential, where prices reflect policy intentions rather than economic realities. This creates a bizarre environment where traditional analysis becomes useless. Value investors wait for decades for fundamentals to reassert themselves, while momentum strategies work until they suddenly don't. Economic indicators flash contradictory signals because different parts of the economy operate under different rules. Employment statistics show strength while labor force participation remains depressed. Inflation appears contained while asset bubbles inflate to historic proportions. Growth appears steady while productivity gains disappear into financial abstraction. The professionals managing institutional money understand this disconnect, but they can't afford to bet against it. Fund managers who refuse to play along get fired for underperforming benchmarks that reflect manipulation rather than market forces. Pension fund administrators who raise questions about sustainability get replaced with more compliant alternatives. Insurance companies that try to price risk honestly get undercut by competitors willing to ignore long-term consequences for short-term market share. This creates a participation trap where even skeptical actors get pulled into supporting systems they know are unsustainable. Everyone becomes complicit because opting out means immediate professional suicide, while playing along offers the possibility of extracting enough wealth to survive the eventual reckoning. The insiders who designed this system understand human psychology well enough to make resistance economically irrational for most participants. But the most sophisticated aspect of the operation is how it manages public perception. The financial media treats market movements as natural phenomena rather than engineered outcomes. Academic economists provide theoretical justification for policies that benefit their institutional funders. Political leaders from both parties maintain the illusion of disagreement while supporting the same core monetary and fiscal frameworks follow finance ensures. The complexity that few of modern people can the money trail or understand how their wealth is being systematically extracted. This explains why crash predictions consistently fail. The analysts making these predictions assume markets operate according to traditional economic principles. They calculate debt to GDP ratios, price to earnings multiples, and historical volatility patterns as if these metrics still determine outcomes. But in a system where intervention trumps mathematics, these calculations become academic exercises rather than practical forecasting tools. The crash will come when the political and financial benefits of preventing it no longer outweigh the costs of intervention. When foreign creditors demand real assets instead of printed currency, when social unrest reaches levels that threaten the stability required for wealth extraction, when the energy and resources needed to maintain the illusion exceed what the system can generate younger, when generations refuse to accept debt obligations created by previous generations for the benefit of a shrinking elite class. These pressure points are building simultaneously, creating multiple potential trigger mechanisms that could cascade beyond the control of even the most sophisticated intervention apparatus. So when will the stock market finally crash? The answer is simple: when it serves the interests of those who control the timing. Until then, the machine will keep running, the wealth will keep flowing upward, and the majority will keep believing they're participating in a fair system while their purchasing power quietly disappears. The crash isn't coming because the market is broken. The crash will come when breaking the market becomes more profitable than sustaining it, and when that day arrives, just like every collapse before it, the connected will prosper, while everyone else pays the price. The only question is whether you'll be ready for what they don't want you to see coming.